it comes to inflation, it seems like a lot of people are expecting inflation to stay high for quite a while, but you're actually looking for inflation to dip. And I guess that could be a reason for the Fed to pivot.
Yeah, exactly. I think inflation has peaked. It's somewhat of a technical thing, comparisons year to year and prices, because prices were up a lot in the last year. As you move forward through the second half of this year, the comparisons allow you to say, hey, yes, inflation's up, but it's not up as much as it was. So part of it's technical, but there's also, when you look at other parts of the inflation equation, like commodity prices, you're seeing a lot of those that have rolled over. Lumber was $1,700 a board foot or whatever in the futures market 2 years ago. It's 600 and change today, and it was it had risen back up into the 12 or 1300 area, not that many months ago, and now is back down. So you're seeing it in certainly lumber, which is a housing related, demand related thing. You've seen some other metals and other commodities come down. It doesn't mean your prices at the supermarket are come down, or that your price on clothes is going to come down, et cetera. That's not what inflation is. Not a price thing. It's the relative change in prices over a broad spectrum of goods and services. I think we're pretty close to the peak if we haven't seen the peak, and I actually think we have seen the peak. I don't know how fast it will come down. And frankly, I don't know that CPI is really the gauge you want to watch. It's a popular one because it gets released and everybody sees it. But there's the Fed watches the consumer deflator index, et cetera. I think we will see that we're going to roll over, and it's just the beginnings of that rollover will have an impact on market participants, I think, in a big way too. So. And by the way, like I said, we may be in recession already, and I think we will be this year. I think this recession morphs into something much worse as we go through next year. So I'm calling for a global bust, and have been for a long time, as how this cycle will end. The reason it turns from just an ordinary recession to something much worse is because we've got debt and derivative levels at levels never in history. I mean, we're off the charts in terms of 300 trillion in debt across the globe, and that's risen just in the pandemic from 250 trillion to 300 trillion. A 50 trillion jump in a couple of years is just a massive amount of debt, and derivatives are in the quadrillions in terms of notional value of derivatives. As I say, debt is the leverage on the economy, and derivatives are the leverage on the market. And what that does when you roll over and you're heading down in both the economy and the markets, what that does is exacerbate it in a big way. So I fully expect a huge financial crisis next year. This to be, the worst downturn economically in the post-World War II era. So I'm not a Pollyanna when I'm talking about this run in the stock market. It's not because I think things are, hunky-dory. It's because you have everybody positioned for something right now that's not going to happen right now, meaning more tightening. And I think so you get people running back. And then I think the Fed, if you get the market up to 6,000, and Nasdaq to 20,000. Given that Powell has bought into Dudley's views on stock market, and needing that being a sign of excess in terms of financial side, you can only imagine that whatever pivot they do this summer, they're going to pivot back and say, "Whoops, maybe we pivoted too soon. We're going back to the tight side." So I think. It's not a straight line. It's a little convoluted, but I do think that's what you're going to see. Is that ultimately, it's not that this cycle is. It's not that the bad news is all over and behind us once we rally. It's just that it's not straight from here. We're going to go to new highs, and then I'm calling for an 80% bear market from those highs. So I think people are just premature in thinking the bust is now. And that's the funny part is the view that's really spooking people is that the Fed doesn't get the damage they're causing, and they're going to cause a global bust. When I started talking about a global bust several years ago, people thought I was nuts. And now that is the forecast that's driving the bears.
At this point, it's not the bust yet, as you're mentioning. We still need to go through that melt up. I wanted to get your perspective on how you see precious metals then playing out through all of this, the melt up and then the crash after that.
Sure. There's been a long road to get here. They had a great run in 2020 coming out of the March 2020 lows, and thought maybe you'd have a few month consolidation of that run. And instead, it turned into a 18-month, 2-year run consolidation. And I think we are now out of that consolidation or coming out of that consolidation. They started to go earlier this year, and then unfortunately, the rise in rates and a strong dollar kind of sidelined them again. But I think we are poised here. They are very critical inflection points where both gold and silver look like they're ready for big runs. I am forecasting. I raised my gold target back in my second quarter letter back in April. So I'm now looking for 3,000 on gold. I was looking for 2,500. So in spite of the frustration of how long it's taken to get here, I actually think the upside this cycle is bigger than it was. In silver, I'm still calling for $50, which is a big run from, it's down in the low 20s. And I think I'm probably going to have to raise that at some point. So, but for now, $50 is my target. I think they will pretty much run coincident with the stock market, with the melt up in the stock market. So I think, again, between now and the end of the year, you should see that run to those targets. And very simply, I think part of it is that the bond market is going to start to rally. Rates are going to start to come down. That will help gold and silver. I think their recognition that maybe the Fed is backing away from the extreme tightening that they were going to do will help. And, again, it's not a straight line from there for the next several years. I do think the bust is going to hit all assets except maybe treasuries. So there will be a correction after we have this big rally in gold and silver. They'll take a pretty good hit in the bust. And then beyond the bust, I think commodities in general are going to do very well, and precious metals especially well. So I'm calling for easily 10,000 on gold by the end of the decade, maybe 20,000. Silver, at least $400. So those are huge runs. If you can get to 50 or 60 in this side of the bust, go through a correction that can take you down 30, 40, 50%, and then a big run to the end of the decade. That's how I see it. In gold, same thing, run to 3,000, maybe you correct back to 2,000, and then run to 10,000, maybe 20.
And when it comes to the miners, how do you see those will perform?
Sure. Yeah, the miners should benefit greatly from the price moves in the metals. I think the miners pretty much mirrored the metals in terms of long consolidation after the August 2020 highs. They are also looking like they are at an important inflection point where they're going to start moving up. And I think you will see that sector of the stock market be among the top performers in the next 6 months.